Did the collapse of Silicon Valley Bank finally pop the housing bubble? And did I just lose $2,000 betting that it hasn't? Let's dig right in. Last week, a good old-fashioned bank run caused the demise of SVB, and in response, the usual cast of second-rate YouTubers rang their alarm bells hard. The way I see it, there are basically two outcomes here. The bearish outcome is that these YouTubers are correct. There's an underlying problem with our banks and the assets they hold, and as the contagion spreads, more banks will fail, which will force businesses to close, which will create a deep recession, and pop, there goes home prices down the drain. The other outcome is that SVB is indeed an isolated case, along with Signature Bank in New York, and that the general strength of the banking system, aided by some new backstops provided by the Fed and FDIC, will hold. If one were to believe in this outcome, they might say, wake up Monday morning and buy a whole bunch of discounted stock in a Northern California-based regional bank. And I'll shortly be getting to which bank stock I bought and how it's performing. But first, let's examine the bearish outcome that will produce a major decline in home prices. So the big concern over SVB is contagion. Contagion that will spread to other banks, crashing the banking system and leading us into a recession as big as or bigger than the Great Recession. In fact, a lot of people have been comparing SVB to Bear Stearns as being the canary in the coal mine. I like to think of Bear Stearns more as patient zero, the first infected bank from which the contagion grew. And what was the contagion back in 2008? Well, it was subprime mortgages. You see, in the early aughts, Bear Stearns created a bunch of new financial instruments by leveraging debt backed by subprime mortgages. Do you remember the scene in The Big Short in which Selena Gomez explains what a collateralized debt obligation is?
So here's how a synthetic CDO works.
You should just watch the scene. It won an Oscar for writing. I'll link in the description. Anyway, subprime mortgages ended up being worthless because lenders were giving loans to people who simply couldn't afford them once the teaser rate expired. So, by 2007, Bear Stearns has two failing hedge funds on its hands: the Bear Stearns High Grade Structured Credit Fund and the Bear Stearns High Grade Structured Credit Enhanced Leverage Fund. These two funds collapsed from $20 billion in assets to basically zero, leading to Bear Stearns' first quarterly loss in 83 years and a credit rating downgrade. By March 2008, nobody would do business with Bear Stearns. The massive investment bank needed a $25 billion loan from the New York Fed, which would have kept the bank solvent for just 4 more weeks. The New York Fed said yes, then no, and ultimately, Bear Stearns was bought by JP Morgan Chase for just 7% of its market value. And of course, the fear then was contagion. But then there was an actual virus, an actual disease to spread from patient zero to the rest of the population. The virus was debt backed by subprime loans, which had been cut into tranches, then levered into CDOs, then proliferated throughout the banking system. And the reason to fear back in 2008 was that the major investment banks didn't know how much of their balance sheets were ultimately backed by subprime loans. As Bear Stearns was collapsing, Congress was debating TARP, the Troubled Asset Relief Program. The banks knew these CDOs and related derivatives were basically worthless, so they lobbied Congress to set aside $700 billion to buy these assets off the banks as they were discovered. Bear Stearns was patient zero with $20 billion of subprime mortgage-backed financial instruments that went to zero. The contagion of 2008 was a proliferation of roughly $700 billion worth of similar assets that had spread throughout the banking system. So now, flash forward exactly 15 years to March 2023. SVB, facing a liquidity crunch, sold some securities at a loss, which spooked depositors and created a bank run in the classical sense. Is SVB the new Bear Stearns? If so, if SVB is the new patient zero, what's the underlying disease? SVB got itself into trouble by buying too many long-term treasuries. SVB's balance sheet has solid top-line numbers, $212 billion in assets and $195 billion in liabilities. The problem here is that SVB owned $91 billion of held-to-maturity securities. What the hell are those? Well, a held-to-maturity security is a fancy way of saying a long-term bond, like a 10-year treasury, that has lost value. The actual value of this $91 billion line item is right here, $76 billion. And this balance sheet is dated December 31st, 2022. So this $91 billion line item was worth even less last week when SVB collapsed. Now, I have to go into some details for just a second about how SVB actually collapsed. Earlier in March, Moody's noticed this problematic line item on SVB's balance sheet and told SVB that they were going to lower the bank's credit rating. To keep this from happening, SVB sold $20-some billion of these held-to-maturity securities, creating about $20 billion of cash for their liquidity, but losing about $1.8 billion from the balance sheet. To make up for this shortfall, SVB announced a plan to sell $2.25 billion of new stock. But it was too late. Depositors were spooked and started pulling out their money, $42 billion of it on just Thursday alone. It was in the truest sense a fear-driven, self-fulfilling bank run. So back to the Bear Stearns comparison. If SVB is patient zero, if we are to fear contagion, what is the disease? What is 2023's version of 2008's subprime mortgages? The answer, of course, must be held-to-maturity securities. As the Fed has raised rates, these long-term bonds have lost value, threatening the banking system as we know it. So I woke up Monday morning and saw that several regional banks' stocks were way down. First Republic, Western Alliance Bank Corporation, and Comerica were hardest hit. The first thing I thought to do was look at their balance sheets to see what percentage of their assets were held to maturity securities. And was I surprised to see that none were even close to holding as many as SVB. So I made a bet. I bought 65 shares of First Republic while taking my morning dump. What nobody seemed to notice Friday and Monday is what happened to the 10-year Treasury yield and mortgage rates. Both fell by 40 basis points. So the collapse of SVB has already resulted in lower mortgage rates, which is going to pull more buyers and more sellers into the market, which is going to produce a more active spring season. Knowing how the broader economy impacts treasuries and how treasuries impact mortgage rates is crucial to understanding the current housing market and where prices are headed. If you want a straightforward explainer, check out this video. And as for my bet on First Republic, right now I'm up almost 28%.